Good morning, everyone. Good afternoon, good evening as well, depending on where you are in the world. Welcome to our webinar on China. This is Joseph Trevisani from Worldwide Markets and FX Street. I thank you all for attending. And as always, if you have any questions or comments or considerations or anything you would like to add, please do so, and I will stop and consider the question. Today's topic is what's going on in China. So let me set this. Okay. China was a source of a great deal of excitement last year and the beginning part of this year. And the excitement was telegraphed through the yuan rate. There are a certain number of statistics or things that the Chinese do where they directly intersect with, shall we say, the real world, where the meaning is patently clear if we are willing to look at it. The yuan is one of those, is maybe the most primary signal that the Chinese give. So let's take a look at what's been going on. For the past 6 months, it's been all quiet in the Middle Kingdom. China has not really impacted on global financial markets. Considerations of what's going on in China have been muted. And in general, China has just disappeared from the global market perspective. Now, considering what went on last August and also last January and February, do we really think that things have suddenly switched and gone hunky-dory in China? Just to go over what's happened. In August 2015, in January and February of this year, and again in June, a sharp fall in the yuan triggered akin to panic in the global financial markets, particularly the equities. Starting on August 10th last year, let me put up a yuan chart for us. Well, I think we'll have to use here yuan loans. I think we'll have to use this one. Like I said, I often prepare my charts in the morning. I come in early on webinar days and prepare my charts in the morning so that they are up to date. Unfortunately, this morning was a traffic disaster for me. I live in Manhattan, but I work in New Jersey, so I have to go over the George Washington Bridge. And that is both a choke point and a funnel. Lovely bridge, but it gets an awful lot of traffic. At any rate, so around August 10th last year, we're talking right here on the yuan chart. This is the yuan chart, the level is here. The Chinese government devalued the yuan about 3% in 3 days. The effect that had, and I'm just looking at American equities here, because if we look at all the equities around the world, we'll have too many charts and we will never get a fix on the fundamentals of what we're talking about. I'll spend too much time on statistics. Over the next 2 weeks, the S&P lost 11%. And just to back it up, the MSCI World Equity Index dropped 10.3. So the trigger in August, right here, last August, was this thoroughly unexpected devaluation in the Chinese yuan. Now, remember my view of how markets trade, or my idea of how markets trade. Markets in general have a overall perception of the world. I mean, all the participants in the markets. When I was trading back in the early 90s and early 2000s, it used to become, what's your view? We meant specifically, what's your view of the currency that particular day? But in general, markets, and now it's pretty much global markets, have a conception about what's going on in the world. It can be right or wrong, but it's what, meaning retrospectively, but it's what powers trading decisions and market decisions. Remember, at that time, a year ago, more than a year ago, China was still looked upon as the driver of economic growth. Much had been said about potential problems in China, but if you look at GDP, it had declined, but not much. There were no real signs that the Chinese government was getting panicky over developments in the world. Now, it was interesting because in the West, say, especially resource countries, they're looking at China as a source of growth. China needs iron ore. China doesn't need coal. China's got a lot of coal. I think the largest remaining fleet of steam engines, steam train engines, as they were called at one time, traction engines. Actually, the traction engines are road engines, but the steam engines for trains. I believe the largest remaining fleet of them, I'm sure of it actually, is in China. And the reason the Chinese still use steam engines is very simple. They have a lot of coal. And they're probably less concerned about environmental effects than more developed countries. That concern is one which comes with wealth and with development. But anyway, so the Chinese economy appeared hopefully from the West. So the perceptions from the West, and Japan as well, and probably Taiwan and all the other countries in Asia, Indonesia, and others that supply resources to China, raw materials, that China would continue to draw in resources. That's great. What does China do with those resources? Well, it does two things. Well, one thing, but it gets used in two ways. It builds factories, it produces things, and it builds infrastructure. Well, the infrastructure will probably continue. The factories will continue, but the problem with building things for sale is that somebody has to buy them. So at the same time, the picture in the developed countries reflected in the markets that China would continue to draw in resources. From the Chinese point of view, it was quite different. The view from the other side of the date line was not based so much on what resources do we need, but where are we going to sell our products? If the economies that we sell to, United States, Japan, the European Union, the European Monetary Union, all around the world are slow or slowing, so much so that their central banks are desperately, and that's what it is, we don't call it that, but that's what it, desperately trying to elevate growth and inflation through zero rate policies, then we are looking at, as from Beijing, from Shanghai, from Guangzhou, from all of the factories scattered all across China, we are looking at slow sales for our products. The Chinese economy is an export economy. I know for years they've been talking about making it a domestically driven consumer economy, but they have not. That requires a great deal more wealth and income than the Chinese have thus far created. Not that the Chinese haven't worked economic miracles, they have. If there's ever been a greater example of the strength and the viability of a system, I'm talking economically here to begin with, that releases or enables the native entrepreneurial spirits, or a better way to put it, the inherent apparent human desire to improve one's life and one's standing and for one's children, than we have seen in China in the past 30 years, I don't know of any. I doubt any exists. I doubt any could exist. So by liberating their economy, the Chinese created wealth. That's what they did. But it took several generations for the United States and Western Europe to get to the level of wealth where the economy itself can be sustained by domestic consumption. So at this period here, the assumption, remember the view in the markets, China, whatever, a lot of it was slightly myopic. We're not looking because we don't want to look. It's good for us. It's good for markets. China's going to continue growing somehow. The miracle of central planning for a capitalist economy or something like that. Nobody really looked at it very carefully. So the assumption was, as many assumptions are, untested. The assumption being that China would continue to draw in resources and its consumption, its usage, its growth would underpin world economic growth. By the way, U.S. On the way in, I was listening to the radio, and U.S. economic growth in the third quarter estimate is going to get downgraded again. Probably not very much, but the U.S. International trade deficit went up again. When that goes up, the way they do the accounting, that detracts from economic growth if the deficit is higher. The last Atlanta Fed, they call it the GDP now, their model that projects economic growth, which is probably the most accurate one out there of the major ones, was at 2.2%. That's probably going to drop again. It's probably maybe around 2% this morning. So we have, and it's kind of astonishing that they started out with what could not have been a projection, but just a hope at like 3.8%, 3.6, 3.8. Now they're down to 2%. So again, it looks like the United States, which is the best developed country growth this year, is going to be sub 2% for 2016. We have 0.8 and 0.1. That's an average, and 1.4. That's a little over 1% average annualized growth for the first half. We add that to 2. We're ending up at a little less than 2.5, then 1.5, maybe 1.4 if anybody can have the calculator in front of them. So the idea that the U.S. is going to grow enough to power the world is the same type of assumption underpinning markets, perceptions, and trading that a year ago we were using for China. So what happened? Out of the blue, in 3 days, China devalues the yuan 3%. Much like my favorite example, which you've heard from me many times, Jean-Claude Trichet saying, whoops, in the summer of 2008, maybe we do have some problems. And all the assumptions about Europe skating through the subprime crisis and everything else crumbled, and all hell broke loose in the markets. That's not quite what happened here, but the idea is very similar. When the Chinese sprang this Beijing, I'd love to go back to Beijing. I haven't been there in about 4 years now, 5 years. Anyway, no reminiscences here. So when China sprang this surprise devaluation on, it crumbled the opinion that the markets have been operating on, the assumption markets have been operating on. And you got this huge collapse in equities. Okay, well, January and February, we saw the same thing. January and February is here. Remember, the yuan is the purple, right? Goes up in August. Do we see a pattern here? Goes up, down, but it always finishes higher. This is an ascending and a very sharply ascending line. It is my contention that this tells you more about the Chinese economy than any of the other statistics that are produced out of the People's Republic. This is where China interacts with the real world, where its statistics interact with the real world, where China is looking for real effects. I know China's latest GDP growth was 6.7. It could be 4.5. Nobody really knows. The industrial production number here, the yellow, 6.3, it could be 4. Nobody really knows. But when they want to sell products abroad, and China is an exporting nation, the yuan rate matters. They could come up with any GDP number they wanted to. It could be 11%. They could come out, nobody believe it, but I mean, they could come out with it. But if they're devaluing the yuan, it doesn't matter. Okay, so then in January and February, we saw another sharp fall in the yuan, but not nearly as half basically what happened here. Here, yuan went down 3%. Here, now I could trace it from here, but you know, we got to draw a line someplace, January and February. What I'm doing is I'm comparing it to the dates on the equities. So the equities didn't fall through this period here. They recovered. Here again, yuan went down 1.7% January and February, but the S&P lost 12%. And the MSCI World Global Index dropped 12.9%. Part of this is the repetition and the shock that we're not finished yet, that things are different than we expect in China. Okay, everybody calms down. In June, another more modest decline in the yuan, 1% over 4 days. The S&P lost 5.3% and the MSCI 7.1%. Now, I'll read you what I wrote in the write-up for this because I think it explains it best. In none of these equity collapses was it the absolute value of the yuan that matters. The yuan was devaluing, but it wasn't the specific translation effect of the yuan into various export items or into various import items that mattered. What was uppermost was what the devaluation represented about the state of the Chinese economy. That is the key to what we're talking about here. So since June, now June was the last devaluation in the yuan. Things have been quiet, but where are we? It's only, well, it's now October, so June, July, August, September. We're only 3 months away. Everybody's forgotten all about it. Yet, if you look at equities, they're all within percentage points of their all-time highs. The yuan hasn't gone back to where it was, meaning the Chinese economy hasn't improved. The yuan now is the lowest it's been since 2010. It's not far from where the government held it after the financial crisis. For 3 periods within the past year, the yuan was taken as a sign, not so much that only that China, but that China as an indicator for the global economy. But as long as it's quiet, nobody's paying any attention. Now, we all know markets work like this. Markets have very short attention spans. Their attention span is shorter than my 8-year-olds. They at least get their homework done. So the devalued yuan is still with us. Now, they have stopped devaluing, but I can almost assure you that if there was another big devaluation in the yuan, we'd get all jittery again. So the Chinese have stabilized the yuan. Is that the reverse signal? The only reason China was devaluing the yuan was to get a better terms of trade. There is no other reason for doing this. This is not a mystery. It gets obscured, as in so many other things on the macro level, when we are trading in the markets. We're not trading the yuan, but when we're trading. So let us now look at some of the other statistics from China to see if we have a better idea of what is going on in the Chinese economy, okay? So I'm going to start with the, pretty where to start here. Okay. Let's start first with the basic one, which is exports. This is year-on-year growth in Chinese exports. You can see what prompted the moves in the yuan. Remember, 2015, yuan, from here on in, the yuan goes like this, all the way up, ascending line to the right. So you can see, look at the slope. Now this, of course, this is a year-on-year number, so this peak is related to this trough. But once you get past that, look at the slope in this line. Year on year, even this slight improvement here, I believe to August, is down 2% on the 2.8%. This is the zero line here. Almost for a year and a half, Chinese exports have declined. They're not growing more slowly, they're actually declining from the prior year. You want to know what China's worried about? That's what they're worried about. Used to call them the mandarins, they're not anymore. Let's look at imports. That's industrial production imports. Okay, imports, also similar type of story, no surprise there. Matter of fact, it could pretty much be the same chart. Why is that? Well, I mean, a good portion of Chinese manufacturers is assembly or reassembly. Certain parts many things are not actually produced in China. Chinese disparity in labor costs is such that you can still ship parts produced elsewhere to China, assemble them there and ship out, and you still come out ahead as far as your costs go. So this is the same chart. There has been a slight uptick in 2016. Let's take a look at the exports as well. Slight uptick in 2016. Saw it in imports, saw it in exports. Okay, let's take a look at another basic one. Let's look at industrial production. Industrial production, similar thing. Lowest in many, many, many years from 2015 on. 2015 on. Slight, and I mean slight uptick in the beginning of the second half of 2016. Nothing to indicate that there is a trend change involved here. Okay. So now we're going to look at some of the sentiment numbers. This is the former HSBC number, I believe. It's a private number on manufacturing PMI. PMI is Purchasing Managers Index. It's not entirely a sentiment number. It's a partial sentiment number, but nevertheless, it's useful. And we have seen here, again, the way these indexes are constructed, and most of these PMI indexes around the world are all pretty much constructed the same way. It's an index, it's not an absolute number. So they start a baseline, and then in this case, it's not a baseline. The way they categorize the responses to the questions, is it growing or not growing, or expanding or not, are then, I think, one is subtracted from the other, if I remember, and that gives you the index. And the index is so constructed, and they're all the same, that if it is, that 50 is the dividing line. So if the index is above 50, that means that particular item, whatever is being measured, or if it's a composite, as this is expanding, and if it's below 50, it's contracting. So we can see that from this manufacturing. Remember, China is primarily a manufacturing country at the moment. I'm sure they're changing, but it is primarily a manufacturing country. So manufacturing doesn't just play the lead indicator as it does in more developed countries for the much more numerous, and if not to say numinous, just numerous, service sector. It's actually the bulk of the economy. So after going to about 45, a little more than 47.3 or so last September, remember, August right here, the month before this, is when China started devaluing its yuan. There are no coincidences involved in this. None. So don't view them as, oh, well, we got here, we got there. No. These things are connected. Okay, so that has recovered to 50.1 right here, came off. This is a private number. So it has been uniformly lower than the official numbers, which I'll show you in a second. Which is, make sure I get the right one. Okay, this is the service equivalent of the number we saw. Never quite made it to 50. Service PMI almost never does. You look at them in the United States and Europe as well. It rarely drops to 50. Much of the service economy is, I won't say fixed, but it is things which continue to be done. You drive to work, that's not a good example. You buy insurance. You eat out. You buy dental services. These things tend to be fairly stable. In other words, they're not the things that get cut from a family budget when money or concern becomes an issue. The things that get cut are manufactured items. Or perhaps you wouldn't go on vacation, so that does factor into the service. But you won't buy a new car. You might not replace your iPhone. You might not buy new clothing. Those are the types of things that are more variable and involve more variable costs. So the manufacturing sector, people will, as they did after the financial crisis, they stop buying things. They just stop buying everything for a couple of months. So the PMIs took a real hit, so you get them below zero. That doesn't usually happen in service economies. Nevertheless, the relative levels are what we're talking about here. So we can see the same thing, got a dip in December and then a rise back to 52. These are not strong numbers, nonetheless. Okay, let us now just take a brief look at inflation. China and its economic planners do not have this obsession with creating inflation that we have at the Fed and other places, and which they are failing at remarkably. When I came in this morning, I just took a brief look at the equities, which seem to be headed up again today after yesterday's rather mild losses. I'm going to talk about that about the bond and rate environment in a few minutes as background to this. But as you can see from China's CPI, this looks familiar, doesn't it? Looks like CPI numbers from around the world. Because as you saw with the devaluation of the yuan, what does devaluation of the yuan mean? It means China's goods are cheaper. It means when I go to buy tools and the price is down because they're made in China, what does that mean for the American manufacturers? Well, either they lower prices or they go out of business over time. So the deflationary forces that are coming out of not only China, but other places as well, the past 7 years, 5 years, and even before that, have seen an enormous addition to the productive capacity of the global economy. We can make many more things than we did 10 years ago. We can produce much more oil. We can mine more coal. We can mine more iron ore. An enormous amount of productive capacity in China and elsewhere, but a large part of it's in China, has been created. It employs people, pays salaries, underpins the economy, but its products have, and the ability to produce them, have outstripped the ability to consume. This is really what the Keynesians are talking about when they talk about the output gap or the consumption gap, whatever they want to call it, and how they justify government spending. They say the problem is not enough consumption. So we need to spur consumption. Well, the reason there isn't enough consumption is because economies in general lack the purchasing capacity to equal the productive capacity. So this will be equated at some point. There are two ways of equating it. You can create wealth. People earn more money. And then they'll be able to buy more goods. Or, and this happens as well, the productive capacity that is unneeded will be written off. It will be destroyed, essentially, in its productive abilities. One of the two will happen. By all of this deficit spending, they're delaying the day, but one of the two will happen. Because if there are factories standing around the world who are producing nothing more than goods that remain unsold, this cannot go on forever. Okay, so back to where we are with China. So China does not have this obsession with creating inflation, and which is a foolish, in my mind, a very foolish way to look at the world anyway. There's no evidence that I know of showing that a 2% inflation rate is good for economic growth. It's good for debt service. It helps to write down enormous government debts. Yes, that's true. But as far as promoting growth, I've never seen any example that shows me that it is an essential ingredient. Why central banks are pursuing it is the topic for another day. Anyway, so remember, here we have the yuan rising. So what do we see? Again, another sharp fall in Chinese inflation, not surprisingly, of course. What does a declining yuan give you? Well, in the West, people who buy their products, it gives you deflation, disinflation. Price pressures down because goods coming out of China are cheaper. But for China, if it had a large portion of imported consumer goods, then what would you expect to see there? What you saw in Japan. Now, I don't have the yuan chart here, but from 2013 on, when the Abe government successfully devalued the yuan by a lot, if I remember, it was about 50%, from 77 to around 120 at the top of the dollar yuan, the dollar yen. What do we see? We saw a spike in Japanese prices. Why? Well, Japan imports almost all of its raw materials. It imports many, many luxury products. They all became more expensive because the yuan was cheaper. It took more yuan, priced in yuan, to buy goods. So yen inflation, forgive me for the Sino and Japanese cultures here for confusing the two. So it took more yen per item to buy imported goods. Also oil, coal, and everything else Japan needs, iron ore. We're looking at a CPI chart out of China in exactly the same period right here where China was devaluing. So now, not by anything like the amount, the percentage amount that Japan did. The total is about it's about 5% actually. 3%, 5, 6% over this period here from August until right now. About a 6% devaluation went against the dollar. The devaluation against the basket that they trade against as well is a little different. But what are we seeing in China? Almost no response in inflation. In fact, from here, we're seeing a devaluation. Now, there are a number of things that are going on here. One is that China is not basically a consumer country. Two, it doesn't import a lot of finished consumer-priced goods from overseas. And three, it imports a lot of oil. And what else was going on in this period? The price of oil was coming off. So despite their devaluation of the yuan by 6%, prices in China have actually gone down. Good for the Chinese consumer, of which there isn't a great deal of them. So what is going on with all of the action we're seeing here? And what is China doing to promote economic growth? Well, the method is different, but the song remains the same. This is new total all-system financing in China. Government numbers, accuracy, don't know quite. Nevertheless, here we are. They're the only figures we have. It could be much more. And I don't know that this counts what's called a shadow system in China. I don't believe it does. I think these are just official numbers. So if you're looking for the actual amount of stimulus, or at least loan activity that's going out, financing activity that's going out into the economy, might be double this. Okay, but look what we see here. In the West, the attempts by the government to promote economic growth have pretty much focused on central banks and central bank policy. Essentially, interest rates by various means. First, all of the central banks in the West dropped their interest rates to zero, and they found out that didn't have much effect. And that wasn't good enough. So what do? They started buying the United States treasuries and MBS to force two particular markets down, the government market and the housing market. And they got their effect. So the economy in the US has been supported by central bank manipulation. Same thing overseas. Japan's been trying this for 20 years. We've spoken about it a number of times. It's one of the things the Keynesians should pay attention to. But religion is hard to dissuade from its beliefs. And in Europe, the same thing. We have not seen the effect desired by the central banks as in self-promoting economic growth. In China, the result desired is the same, support economic growth, but the method is different. The Chinese throw money at the economy through loans. Targeted sectors, targeted companies, targeted loan disbursement. This, like the yuan level, is one of those statistics that intersects and interacts with the real world. Assuming that the statistics are not erroneous, When China devalues the yuan, it's telling you something, a macro fact about the economy. When in January of this year, the largest amount of financing was thrown out into the Chinese economy by the government, that tells you something important about China. It's something which markets will look at briefly and then disappear. In fact, this did not have that much effect, although I suppose it did combine with the yuan, the prior and the current at the same time as this yuan devaluation. But the markets forget about these things. But it doesn't change the background. This aggregate financing, to me, is, and here's another number. This is new yuan loans. It's not all system financing, it's just yuan loans. Again, in the beginning of 2016, almost 7 years into this vaunted recovery, the Chinese economy, remember, it's got to sell things to the world. So you see two things here. China's devaluing its currency. There's only one reason to devalue your currency. As we already said, we don't have to do it again. And, excuse me, what does this mean? Well, it means that the necessity of keeping the economic engine running, of people employed, is faltering from lack of demand. If there was demand for production and new factories in China based on actual demand, then there would be no need. Now, there is an annual factor in this as well. If you look in the Januaries of every year, here, almost here, here. There is an annual factor in this. This type of financing does increase in January for the very simple reason China runs on a calendar year as we do, and the loans are ordered and dispersed, ordered in the latter part of the prior year, dispersed in January, and then spent through the remainder of the year. So when you look at aggregate financing, which we had here, where's my aggregate financing number? And this is, okay, let's bring this one up. This is aggregate financing and GDP. Okay, so you can see that in the beginning of almost every year, there is a big spurt in loans because that's when the loans are created and dispersed, okay? Now, there is something interesting here as well. This is China all finance. Is this all financing? No, this is new yuan loans and GDP. One is going up and one is going down. One is rising left to right and one is falling left to right, and you don't have to guess which is which. The disbursement of loans, the increasing disbursement of loans, the line on this is going to look something like this, right up through the middle here, right? Has not produced GDP. This is the story everywhere around the world. You think eventually the central banks are going to get it. Okay, hold on. This is a similar number. This is GDP. Actually, no, yeah, this is GDP, hold on. Industrial production and the Chinese yuan. So remember what we saw earlier, the prior chart. Yuan loans go up, GDP goes down. So we have the domestic side. where the Chinese government is attempting to support economic growth by spending money, basically. And its effect has been minimal. Here we have another attempt. This is the other side. This is the export side. Yellow is industrial production. White, GDP. Purple, the yuan. So if you look at it objectively, since the end of 2013, so 2.5 years, China has been devaluing its yuan, its terms of trade with the world, for 2.5 years. And what do we see as a response from here? Well, from industrial production, we've gone to a little bit less than 10% annualized to year on year to 6.3. What do we see in the GDP? We've gone from the least reliable figures coming out of China, probably, from about 7.7 to about 6.7. Yuan has devalued from here to here. So the effect, now we have to assume that both of these policies from the central government, the spending of vast amounts of money, government money in the economy, and the devaluing of the yuan, have had an effect. They have to have done something. So what is the effect? Even taking the Chinese statistics at face value, the only thing we can see and note is that they may have, that we have to infer, we have to posit that the effect has simply slowed the decline. Think about that. Let's go back and look at this chart. Oh, that's not a particularly good one. That's the actual, this is, no, okay, I'll show it to you. This is a GDP, this is industrial production, this is financing. So you see them on the same chart. And you can see, again, there's very little effect here. Okay, so let me just pull up one more. This is one we had before. We'll go with this one. So the conclusion we must come to by examining these, the statistics, meaning the currency rate and the all system and yuan loans, those two factors that intersect with the real world, the conclusion we must come to is, one, China wouldn't be doing these things unless they felt it was necessary. Two, that they have not produced, this is just empirical, they have not produced a change in the rate of growth in any of the statistics out there. And three, meaning that the actual state of China's economy based on non-supportive conditions is far worse. That the equivalent that we're seeing, and this is why these policies are the same. They around the world, they are simply expressed differently. It's very difficult not to look around the globe in the macro environment and look at the overall picture and not see the congruence of central bank policy and the congruence of need. In my many discussions, both in print and otherwise, of Fed policy, the conclusion you must come to, here, let me just show you one more chart. So we've explored why China, what Chinese policy is telling you about the economy. These are sovereign rates. Let's see, German is green. Italy is yellow 10-year. US is purple. And Spain is white. So the US 10-year is the highest out there. The US has a developed economy, probably in the best shape in the world. Does it make any sense that all of these countries, except for maybe Germany, are paying less to lend money for 10 years? So the question is, why are they doing that? And that's, of course, because the ECB is out there buying up everything in creation. Well, markets still operate as markets. If there's a bid, it forces prices higher and rates lower. These are as artificial as can possibly be. They are as artificial as the growth prospects in China, supported by trillions of yuan spending from the central government. The Fed has been in the lead on all this stuff. The Fed is now saying we need to raise rates. I think I wrote a short piece yesterday. There were 6 Fed governors pretty much out there in various guises in the past month and a half saying we need to raise rates. Why? The US economy is going to be growing at less than 2% in 2016. By what definition of central bank policy does that require a rate increase? What policy? And it's interesting that well, no, we'll leave that one alone. That involves politics. So the reason the Fed is so hard-pressed and so hell-bent on raising interest rates is because it's terrified, I think, of what will happen when a recession comes. And a recession is going to come, it always does. So what we're seeing here is we're approaching, I think, both in China and elsewhere, of the end game for central bank rate policy, because the policies themselves cannot create growth. The question for China is quite simple. How long can you spend $3.5 trillion every January to support the economy the rest of the year? The question for the central banks in the West is, how long can you distort the basic input, price input in a capitalist economy, which is the price of money? We don't know the answer, but I fear we are about to find out. Okay, everyone, I thank you all very much for attending. I hope this was useful. I hope it was entertaining. I hope we all learned something, including myself. I will put my email address up there if you have any questions, comments, considerations, or, as I always ask for, jokes. Please send them to me and I will be glad to answer. Thank you all very much for attending, and everyone have a great day.